Hi, my name is Aziz, a fellow of the Association of Chartered Certified Accountants. Welcome to part 4B of the course, Bookkeeping up to Final Accounts. Today, I'm going to talk about how to agree bank charges with your bank manager when opening your bank account. The second item is fixed asset or non-current asset definition. Definition given by Financial Reporting Standard 102, that is FRS 102, and International Accounting Standard 116, IAS 16, and then followed by capitalization limits, which will be stated in every company's financial control or financial regulation, and then the fixed asset register. So let's get started. Let's start with the first topic, which is agreeing bank charges with your bank manager. Now, at the very beginning, when opening your bank account, you should fix your bank charges or agree your bank charges with your bank manager at the time of opening your bank account. Now, this will save you a lot of money in the long run, and you also avoid being nastily surprised when you receive your bank statement every month, your business bank statement every month. It is also good for budgeting, and you can also monitor your bank charges, costs. Please do negotiate very well at this stage. But if bank charges turn out to be higher than what you agree with your bank manager, you should arrange to see your bank manager straight away. If everything else fails, if you fail to secure a reasonable deal after having a meeting with your bank manager, please do shop around for a better deal. You are not tied to any bank. It's a free market. Please, because a lot of business banks are there to support your businesses, but at the same time, if you do not lay down the rule, you don't lay down the law from the very beginning, it could just turn out to be the other way around. I mean, banks actually driving your business all the way to the grave instead of helping your businesses, because you have not agreed what your charges should be at the beginning. So now, if I show you this simple spreadsheet that I believe you should use before you go to see your bank manager, here is the breakdown. Calculate what you think your bank charges should be. The very first item you should agree with your bank manager is what they call account maintenance fee, which is £9. I mean, in this case, this is just for illustration, for the purpose of illustration. Now, moving down to the details, you have to honestly let your bank managers know that on average, you'll be making, say, like 8 direct debits. Say, the number of direct debits you'll be making every month, and the bank manager will tell you how much that will cost per direct debit. It could be 50p. This is just for the illustration. Now, you also be making automated direct debits on your bank account. I mean, automated debits. The bank manager will let you know how much will be charged for each automated debit. Let's say each debit is going to be, in total, the volume will be 11 per month. If the bank manager agrees 40 pence, then it means every month, automated debit will cost you £4.40. Look at all the others. Bank charges, BACS, payment by BACS, manual credits, checks paid in, check deposit on the bank's counter. How many checks will you be depositing every month? On average, if you tell your bank manager you'll be depositing 20 checks, the bank manager will probably say, okay, every check will cost you 30 pence, which means in a month, the bank will charge you £6 for all the checks that you have deposited. Now, in total, the bank manager will then charge you every month, total item charge for all the items, £54.40, as shown by this spreadsheet. Now, bank charges, £63 in total, together with the maintenance charge for the month. Now, you look at the summary here. Now, you should walk out of your bank manager's office with this summary. After having your discussion with your bank manager, you should come up with this summary. In total, BACS payment or BACS transaction will cost you £22. Like I said before, these are just figures that I came up with just to demonstrate how this thing works. Okay? Direct credit to your bank account, maybe people pay money into your bank account by BACS or whatever. They pay money direct into your bank account. In total, every month the bank will charge £15 for that. Now, checks, based on the number of checks we've told the manager that you'll be paying into your bank account every month, will be £4. Direct debit £4 every month. In total, every month, including account maintenance charge of £9, your bank charge will come to £63.40, according to this demonstration. Now, which means if you now project this forward, you multiply it by 12, which means annually your bank charge will come to about £760 and 80. Now, you should base your budget on that. When you are preparing your budget for the month or for the year, you should include somewhere in your budget that your bank charges will be £760, 80. And you then have to monitor that on a monthly basis. If your bank charge on a monthly in any particular month is greater than £63 and £40 that I've stated here on this spreadsheet, then you need to look at the components of the charge. If you have kept to the number of say BACS payment and you have been charged more for BACS payment, which means the bank manager has broken his promise and has increased your bank charge beyond above what you have agreed. See that bank manager immediately to negotiate, to find out why. If you cannot get him to change his mind, please look around for a better deal. Don't just stay with the same bank until they get your business into a very big mess. So, very simple. So, if I leave that and move on to the next topic, which is fixed asset, which is what we commonly call our assets in the UK, business assets in the UK. They also call it non-current assets, those on the international scene. Now, the fixed assets or non-current assets or plant property and equipment, as they are sometimes called, they are governed by two financial reporting standards. Okay? They are governed by Financial Reporting Standard 102 in the United Kingdom. Financial reporting standards are there to regulate the way you treat transactions, the way you treat and process transactions. That is what financial reporting standards do. This is to remove that element of judgment from accounting treatment of transactions, our accounting, yeah. So the reason for this is that it's just to make it easy for your financial statement to be comparable for with those of other businesses in the same sector, and to be comparable with from year to year, even in your own business. So, Financial Reporting Standard 102 came into being on the 1st of January 2015, and it is applicable in the United Kingdom and the Republic of Ireland. Whereas IAS 16 is what big businesses use. That is applicable worldwide. But Financial Reporting Standard is only applicable to the United Kingdom and Republic of Ireland. Now, if I move away from that and move on to capitalization of transactions, when I mean capitalization, I mean treating expenditure as fixed assets. Now, every organization has what they call financial regulation of finance control policy. Somewhere in that financial regulation of financial control policy, there will be a limit of the amount that can be treated as capital. For instance, your financial regulation or financial control policy could state that any amount of expenditure that is above £1,000 will be treated as a fixed asset expenditure or capitalized. Any amount below that will be treated as revenue. Now, again, there is something there that I need to explain. If you say any amount below £1,000 will be treated as revenue, or any amount above £1,000 will be treated as capital, some amount may fall below £1,000 and still end up being treated as capital if they form part of a series of expenditure. Series. So you go out and buy maybe laptops for £500 each, that is clearly below £1,000. If you buy 10 in one go on the same day from the same supplier, then collectively that'll be about £5,000. So they will fall. Collectively, they fall below. I mean, they will be above capitalization limit, and therefore you have to capitalize. They'll be above the limit that you set, that £1,000 limit that you have set. So you capitalize. But if you just go out and buy one laptop for £500, that is clearly going to fall below for £1,000 that you expense. Now, that does not mean that you will expense and forget all about it. You could open a record for it somewhere, say, asset below £1,000, so that you can keep track of those assets, so that they don't just vanish. Because when you capitalize an asset, or you treat an asset, something as capital expenditure, you have to track it. You have to give it codes. You have to monitor its use. You have to hold somebody responsible for the custody of that asset. Now, but items that you've said are not capital, they get forgotten about because they will not serve you beyond 1 year. Now, Financial Reporting Standard 102 and IAS 16, International Accounting Standard number 16, the definition of capital is very similar. Okay? The definition of capital is very, very similar. Now, according to the UK Accounting Standard Board, assets, when you call something an asset, it means that thing confers rights on you. It gives you right or access to future economic benefits, which you will control, which your organization will control as a result of past transactions. Now, let me rephrase that. Assets, according to Accounting Standard Board, are rights or access to future economic benefits, which your entity will control as a result of past transactions. What that means is that what you have spent money on, which you have called which you have decided to capitalize, will give you exclusive right to benefits, and the right could be by way of income, which that item will bring to you. You will use that item to make money, or maybe you could use that item for business purpose, like an office. If you have a building and use it for business or manufacturing, or use at a store, you are again deriving benefit from that item. So, as a result of past transactions. Now, what they are actually saying there is that the transactions bringing that item into existence must have been finished. In the case of a building, you must have already incurred the costs relating to that building. Everything must have finished completely, must be in the past. If you are still incurring the cost, then that cannot be called as an asset. It will be called work in progress. But if you have finished it, if it's all in the past, it's not work in progress anymore, it becomes an asset. And the economic benefit that you will derive from that must be controlled by yourself. No other person must have access to those economic benefits by way of income or usage of that property. Now, the cost that we regard as the cost of doing the asset will be costs that are directly attributable to that item, such as acquisition costs, such as site preparation costs, which I demonstrated earlier on when I was coding the building enhancement costs, and installation costs, which I also demonstrated earlier on when I was coding the components of the website development cost. And then, of course, the professional fees like architects and so on and so forth. Now, so if I just move on now and show you, because when you have fixed assets, in addition to the record that you have in the nominal ledger about the transaction, you must also have what they call an asset register. An asset register looks like this. Yeah? In the asset register, you have what they call asset master record. The asset master record, for instance, for this leasehold property, if we show you the name of the asset, which is leasehold property, and the asset class, every asset must belong in a class. Okay? Say you buy an item of computer, you could classify it as plant property and equipment. If you have a building, that will come under land and building as a class, or building as a class. Okay? Now, you must have a detailed description of the asset. For instance, office, store, motor garage, etc. The location of the asset will be in the asset master class. What the asset costs, the cost of the asset must be in the master class. Now, in the case of the land and building for Joe Blocks Auto Services Limited, the total cost is £250, £250,000. But for ease of depreciation calculation, I have split that cost into £100,000 land and building element. The land element is 100,000. The building element is 250,000 pounds. Now, because it's an item that you have acquired through a finance lease, the payment terms is also stated, and the date on which the payment will be made to the lessor, which is the 15th day of the month, is clearly stated. The length of the lease term is 25 years. Now, the lessor, that is the legal owner of the property, is stated together with contact details. The commencement date of the lease is also stated there. Now, the termination terms is there. The estimated useful economic life of the asset is 50 years, even though the lease term is 25 years. But the asset is expected to be useful for 50 years. That, again, is not set in stone, because an asset could be revalued upward. The building could still be here in 60, 70 years' time, but this is just an estimate, 50 years. Now, the asset, of course, will be registered. Your land registry number will be there. In service date, this date is very, very important. In service date is the date the asset will be brought into use. Okay? Now, so that shows that those are the details that your fixed asset register must contain. I mean, the master record of your fixed asset register. But again, when you have there's another side of the fixed asset register, the rest of it. Now, you will have an asset account in the nominal ledger. Okay? That will be in the nominal ledger. But at the same time, you will have another asset register, like an on Excel, ideally, which will give you a breakdown of what is in the nominal ledger. Now, on the Excel register, you will have the cost of the asset, of course. You have the date the asset was acquired, the name of the supplier, invoice number, asset description, asset category or class, where the asset is located, who is responsible for the asset, which I've already discussed, and then the cost of the asset, the total depreciation that has been charged on the asset from the date it was bought up to now. Then the balance sheet code, that is nominal ledger code, must be indicated. The profit and loss account code. Now, I will talk about that. Now, the profit and loss account code. Now, that is the code where you will record the other side of the depreciation charges. Now, when you I will talk more about that when we get to the depreciation stages, and I will demonstrate it to you. Okay? Because when you charge depreciation, one part of the charge, the debit charge of the charge, the debit side of the charge will go to depreciation expense account, and the credit side will go to the cumulative depreciation account. One account is a balance sheet code, which is the cumulative one. The P&L account, with the other one, is in the income statement or P&L account side, which is the expense account. That I will demonstrate and explain further later on. Okay? So, now that brings me to the end of this video. Please do like and share, and I see you later on. And of course, don't forget to click the subscribe button. So I will see you in my next video. Do take care. Thank you. Bye.